Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site, we have Brian Joyce, who's Managing Director at Nasdaq Market Intelligence Desk with our midday update. Brian, great to have you with me as always, and it seems to be that stocks are shrugging off tariff issues, but really into what the Fed is saying.
Yeah, so it's been an interesting week. We're seeing a bit of a relief rally, which was not unexpected. We had about a month of declines in the broader indices. The Dow Jones Industrials, however, ended May on a streak of 6 weekly declines. It's never in the history of the Dow, at least going back to 1900, has seen 7 weeks down in a row. So we put out a note on Monday thinking it's never happened before. Let's expect this week maybe to see a bit of a relief rally. Doesn't mean the lows are in, but at least more of a what you call a dead cat bounce.
Even during the financial crisis, we did not see 7 weeks in a row.
Correct. The financial crisis, the Asian currency crisis in the 90s, the Great Depression in the 20s. We never had the Dow down 7 weeks in a row.
I mean, that's quite incredible, because if we were to get that, I'm sure the narrative will be much different. Another thing that we were talking about last week was the 10-year. Let's pull up a chart on that, because you had identified some key levels here.
Yeah, so looking here right now, actually, this is the rate differentials. This is the 10-year U.S. Treasury versus 10-year German bonds. It's an interesting chart. We've been highlighting this chart on numerous occasions, particularly because it made a 30-year high in November and has since been declining, largely due to the fact that, based on expectations that the Fed is going to ease. And that's what we're seeing now. The drumbeats get louder and louder for more easing and a rate cut now here in 2019. On Friday, we had the Mexico tariff crisis and the new trade war, or the new front for the trade war, so to speak. And what happened on Friday and Monday? We finally got the break in this rate differential. We broke the 240 pip neckline, which has been in place for about 12 months. It's a pretty big topping pattern. We had the breakdown. We went down to about 227 at Monday's low. The size of the topping pattern has a price level projection of 200 basis points. So we have another 20, 25 bips from the lows to go before we reach the measured move. The reason that's important is because the collapsing rate differentials, in this case, should be bullish for the euro, all else being equal.
All right, now if we take a look at the next chart, we can see you're looking at the euro and the U.S. dollar.
Right, so the euro this week is making its move. We've been highlighting this chart. This is the weekly setup. You know, what's driving the price action of the euro? Well, we have the collapsing rate differentials. What's been coming into this week, we've seen the extreme narrow coiling price action, which we've highlighted by looking at the measure of the width between the upper and lower Bollinger Bands, the weekly bands, which are just coming off 40-year lows. So that tells you the extreme price compression, narrow ranges, and from extreme lows, we get expansion. And so this could be the start of that expansion on this week's breakout. Yesterday, we had Chairman Jay Powell speak, and his message was interpreted to be dovish. He said they're monitoring the trade war developments, and they stand ready to act if need be. Today we had the ECB speak, and while they said some things dovish, they also made comments that they actually raised their expectations for growth and inflation for 2019. So not as dovish as people were expecting, so that's also a positive there for the euro, relatively speaking. So we're getting a 1.25% move to the upside this week. It's breaking down the declining trend line in place since mid-2018. This week's move is the biggest we've seen in 2019 and would be a top 5 move for last year. So my expectation is we could see some further upside, or this could be the early stages of a bullish upside reversal given the extreme price compression that we've been seeing throughout the first half of 2019. It could be setting up for a pretty powerful move to the
All right, now on the blog this afternoon, you looked at gold extensively. We could take a look at the next chart here, hitting multi-year resistance levels. So it looks like you're expecting a move to the upside just by looking at the chart.
Right, and the reason I looked at gold today, and I've been staying away from gold for quite a while because it's just been not doing very much. We had a 45% decline from the 2011 high to the 2015 low. Since early 2014, late 2013, it's been seeing clearly reliable resistance at this 1350, 1380 range. 1380, coincidentally, equals the 38.2% retracement of that entire multi-year downtrend from 2011 to 2015. So there's a very strong correlation between the euro and gold. It's a positive correlation. So if we're going to see an upside breakout in the euro, I would look for an upside breakout in gold. And as you can see, the momentum measure, the RSI, on a monthly basis is up against the highs it's been making since 2016. So that's about a 3-4 year resistance level itself. So price is testing resistance, momentum is testing resistance. If momentum breaks out, and oftentimes it does lead price, and right now it's at 59, the prior high is 56, it's beginning to break out. If it can hold this level and higher for the rest of the month, We have a few weeks to go, but that could be your indicator that gold is, on its way to making new highs.
This chart makes me feel old. I remember covering it back in 2012 and 2013 when we had the extreme volatility in it, and flash forward, here we are 6 years later. Brian, as always, thank you for joining me at MarketSite.
Thank you.
And thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.